$73 per barrel at some point, yet the slight bullish movement seems to remain unconvincing for now. Prospects for future demand and production levels seem to remain in the epicenter of attention for market participants, guiding the market sentiment and oil prices. In this report, we aim to shed light on the factors driving WTI's price and asset future outlook. Since the beginning of the week, there were rumors in the oil market that the US oil market is tightening. Despite the rumors, we have to note that on Friday, the Baker Hughes oil rig count showcased that the number of active oil rigs in the US dropped even further, reaching 575, the lowest in about a year, implying reduced demand. On the other hand, though, we had complete reversal of the increases in US oil reserves, and it's characteristic that API reported a drawdown of minus 6.8 million barrels, while EIA showed an even wider drawdown of almost minus 12.5 million barrels, in a sign that the oil production in the US was not able to reach and surpass demand levels. The reduction of US oil inventories, and especially the size of the drawdowns reported, was characteristic of how tight the US oil market got over the past 10 days. Overall, we expect the tightening of the US oil market seem to provide some support for oil prices, and should it be maintained, we may see oil pricing rising further. Oil participants tend to maintain their worries for the demand outlook of the commodity, especially as market worries for a possible default of the US on its debt seem to intensify. It should be noted that Republican lawmakers are to leave for a long weekend today, which lowers the chances for an agreement between the White House and the House of Representatives in the next few days. Nevertheless, House Speaker McCarthy stated that he could get a deal on raising the debt ceiling in principle by this weekend. Please note that the ongoing negotiations and the lack of common ground caused Fitch to place the US AAA rating under credit watch negative. The development intensified market worries further, and understandably, oil traders fear for the possible adverse effect such a scenario may have on oil prices. Furthermore, the news that Germany, a key industrial economy that still consumes a considerable amount of oil, fell into recession, even a technical one, tended to intensify market worries for the demand side of the economy. It should be noted that the contraction of economic activity in Germany's manufacturing sector over the past 10 months may enhance some worries, which in turn may weigh on oil's price. Last but not least, we could not miss out on Saudi Arabia's energy minister, Prince Abdulaziz bin Salman. The Saudi minister warned practically oil short sellers that the OPEC meeting is incoming at the beginning of June, implying of the oil-producing cartel's ability to cut oil production levels and thus raise oil prices. Market worries for further oil production tightening were mitigated through on Thursday, as Russia's energy minister Novak stated that he does not expect the OPEC to reduce oil production levels further in its next meeting. Thank you for watching.